Hey everyone, I wanted to discuss Bitcoin today. Obviously, the price level is getting way up there. Everyone's wondering, should I jump on board? Prominent people, investors, CEOs, companies are buying Bitcoin finally. So it really seems like this thing's about to take off. And I want to discuss today what I hope to show are sound economic principles as to why Bitcoin is already a failure and why the price is ultimately going to crash and burn. I'm not the only person saying this. Some of what I'm pulling is from a guy on Twitter called Jacob Oracle, who's got some great graphs in relation to the stable coin called Tether, which I will get into in a little bit. But many other people, such as Robert Kiyosaki, even Simon Dixon, who he interviews in a recent podcast episode of his, and then a guy named Jimmy Song, who is a Bitcoin developer, a Christian, and a prominent advocate for Bitcoin, are all still selling it, still investing, and still pushing it. And I have yet to hear any of them discuss what I'm going to talk about today, which is called commodity standard price equilibrium. And please be patient with me and endure. That might sound complex, but I think it's something that everybody can understand. And again, it's something I have yet to hear anybody, including the Winklevoss twins, who are the ones that really push Bitcoin as new gold, digital gold, gold 2.0. They think it's going to disrupt the entire market, which is why they have their price valuation of 500,000 on Bitcoin, because they think it's going to disrupt the metals market. None of them, from what I understand, have discussed commodity standard price equilibrium. And the fact that Bitcoin cannot achieve that, which is why it is a failure, it is not a commodity, it cannot be used as money, and it is ultimately worthless and nothing. If we're going to understand Bitcoin and whether or not it can become gold 2.0, we have to understand gold and the history of commodity standards, because that's the comparison that we are making, whether or not Bitcoin can disrupt those markets successfully. There are a few qualities of Bitcoin that make it look like it might be able to, but I will bring forward what I think are the reasons why it's never going to happen. I've gotten this knowledge from a book called Theory of Monetary Institutions by Lawrence White. Chapter 2 is available online in PDF form and is a chapter dedicated to what I'm going to be discussing. Let me make it clear quick too that I'm not talking about blockchain technology. I'm not talking about just the immutable ledgers and underlying mechanics behind how Bitcoin works. Of course, there are great things with crypto technology. There's a whole new industry and realm of opportunity that's awesome. I personally have programmed a smart contract blockchain system in industry, so I've got a little experience. It's great stuff. What I'm specifically talking about today is the coin issued on top of the Bitcoin blockchain, of course named Bitcoin. So to jump right to it, commodity standard price equilibrium is incredibly important because it's the very tenet of a commodity standard that brings stability to a country's currency and money system. Stability and honest units of metrics are the entire goal of currency. Currency and money is issued in order to exchange value in a way that has integrity and honesty, and that I know that what I'm giving you is represented fairly by what you're giving me. If we're going to talk about gold and commodity standards, we have to purge our mind of the idea of dollars for a minute. This may seem very counterintuitive because almost every one of us prices everything that we know in life on dollars. How much is a camera worth? How much is an ounce of gold worth? We think dollar values. So for example, an ounce of gold as of making this video is worth somewhere around $1,800. So we immediately associate gold with a value in dollars. In reality, it's quite the opposite. When we look at the price of gold in dollars, what we're really assessing is the value of the dollar. If the price of gold goes up, what that really means is that the dollar got weaker. There could, of course, be multiple reasons for this. One of the common reasons is inflation. So if you print a bunch of dollars and just out of thin air debit and create money, then they flood the system, and naturally the price of gold is going to go up because you flooded the system with dollars or inflated the system, and therefore the prices have to rise on the commodities such as gold. So really what's happened is the dollar has gotten weaker. Nothing has happened to gold. 1 ounce of gold is still 1 ounce of gold is still 1 ounce of gold. So when we're looking at commodity standards and the history of money, for a minute, we're going to put dollars out of our minds because we can look at gold in comparison to other goods, just like they used to do when gold and commodities were traded amongst each other as money or currency. Obviously, we've stepped away from that for a few degrees, but it's important to understand these principles if we're going to look at Bitcoin and whether or not it can disrupt gold. In classic systems, people used to just trade goods directly. I give you bacon, you give me milk. But turns out sometimes I don't need your milk, or you don't need my bacon, or whichever way it goes, or I have too much of that already, so I need some other way to store value. Gold and metals have classically, historically, for thousands of years been understood to be good value stores for various reasons and properties. Bitcoin does appear to replicate some of those qualities of what makes something a value store, but the area in which it fails is the ability to be used as money, which is key and critical to achieving commodity standard price equilibrium. All that commodity standard price equilibrium means is that a certain amount of gold will generally always represent the same amount of another good. So for example, if I bought a nice men's suit in the early 1900s with an ounce of gold, 100 years later, it should buy me a nice men's suit too, because it represents a certain amount of another commodity and it will retain that ability to represent it. Unlike with the American dollar currently, which is backed by nothing, it's literally just paper. And as you can imagine, the price of a nice men's suit is quite drastically different today than it was 100 years ago. The equilibrium point, which brings the stability to the currency again, is found between the ebb and flow of supply and demand of the commodity into two different markets. So again, if we're looking at gold, gold is mined out of the ground and then it can flow into one of two markets. There's the consumptive usage for gold and then there's the money usage for gold. Now, those two markets are somewhat interrelated because the fact that people recognize gold and silver to be objects of wealth and therefore they want to wear them and own them and make certain objects out of them or plate with them is contingent on the fact that gold is also used as money. If gold couldn't be used as money and there was no purposefulness to it and it wasn't so scarce and it wasn't a good value store, people would not dig it out of the ground nearly as much as they do now. Now, there is also a small amount of industry usage for gold, such as in dental fillings, circuit boards, cables, and other things. Whichever you prefer, the wearing of it or the industry use, that creates a consumptive market. So this is very important because when gold is pulled out of the ground and enters into economy, gold can either be made into the coinage and the money supply, or it can flow into other uses. The flow between money supply and other uses is where the commodity standard price equilibrium is achieved. The ability to find that equilibrium point of a certain amount of gold against another commodity is contingent on the fact that there is a societal use and consumptive purpose to that commodity. Stability cannot be found without that, and Bitcoin has no such usage. Bitcoin is electrons cryptographically secured in an immutable ledger, which is basically a glorified database. So, in a classic bartering system, turns out that gold and silver work pretty well because they retain value and I can set them on a shelf until I'm ready to use them. However, in the raw state, just pulled out of the ground, gold is impure, it's not well formed, it's not easily transportable, there's a lot of issues with it in its raw state. So, it has to be made into money, which requires regulation, it requires control, and it requires institutions that enable that. The regulation and control of that commodity into currency is key. And ironically, that is the exact reason why Bitcoin fails, even though that is what it claims are its strengths. Bitcoin says, oh, I'm decentralized, I'm deregulated, nobody controls me, I work on my own. But it turns out that is the exact opposite of what we want for something that is going to be made into a currency. Because again, we want to have something that is stable and can be used as an honest metric for value exchange. Since no one can control Bitcoin and it is completely unregulated, there is no supply and demand effect of Bitcoin. Once it's entered into the system, that's it. It goes nowhere. And on top of that, there is no usefulness of Bitcoin outside of allegedly being money. That is another key to having a commodity standard and achieving commodity standard price equilibrium. And since Bitcoin is decentralized and unregulated and cannot be controlled and therefore cannot be used as money because no institution can regulate the flow of it in and out of an economy or a society, the entire purpose for which Bitcoin was designed is a failure. That is why I said in the beginning of the video, Bitcoin has failed. It literally undermines itself by its own design. A common alleged strength of the Bitcoin system is the limited supply, that we know there's only about 21 million coins that will ever be in existence. But here's the ironic part. Limited supply is not necessary for a commodity standard. What is necessary is the ebb and flow between two markets. It doesn't matter if gold runs out or not. Back at one point in time, silver was also used as part of a commodity standard too. So there's other options. It's not just about having a limited resource. It's about the fact that that commodity has a usefulness and consumptive purpose within a society, which Bitcoin does not and never will. Many prominent investors and thinkers on Bitcoin readily acknowledge that Bitcoin is incredibly and entirely speculative as a store of value. They acknowledge that metals for thousands of years have been proven by humans to have value and be known as a store of wealth. And many think that it's just a matter of time before Bitcoin will be able to be realized as that too. I submit, because of these economic principles that I've brought forward, it will never be the case because Bitcoin has no societal usefulness or no consumptive purposes. It can never have a price equilibrium, which is necessary to providing stability to a country's currency system, which is the entire point and purpose of having currency and money, which is to provide an honest unit of exchange or metric of exchange with integrity. The fact that Bitcoin is unregulated and decentralized leaves it open to a lot of problems. And this is exactly what explains the last rise in price level we saw, as well as this current one. Jacob Oracle on Twitter has a phenomenal stream, if you want to go check it out, on how the Tether stablecoin, another cryptocurrency, has largely been what's causing the Bitcoin price to go up. Long story short, 80% of all Bitcoins are traded in Tether. Tether is issued at will by the company. And though they claim it has a $1 backing, meaning that every Tether coin issued should be backed by $1 American, their lawyer in court has already admitted that they only have about a 74% backing at best, as far as we are aware, to their Tether coins. What does this mean? This means that Tether is introducing their own layer of inflation into the crypto market. So this is what I call multi-tiered inflation. So you've got the American dollar, which is based on nothing. It's backed up by no commodity, no gold, no silver, no nothing. Our government can print it whenever they want, how much they want, and send people checks in the mail all day. The Federal Reserve has quantitative easing power and all sorts of stuff. So point being, the American dollar is inflating, and then Tether, which claims to be based on the American dollar, also can inflate its own currency or cryptocurrency, Tether, and then 80% of all those flow into the price of Bitcoin. It is quite clear, and this is again the same case for the last rise to the price level of about 19,000, that it's largely and primarily driven by the issuance of Tether coins. So you've got a completely speculative investment that is unregulated, uncontrolled, completely open to fraud, manipulation, and basically anarchy, which is the entire problem with cryptocurrencies right now, is this idea that we can set any system outside of human control and expect it to run in an orderly fashion. Now, of course, things in human control fall out of order as well, but case in point, humans are at the center of each issue, both in the crypto market and the issuance of Tether coins, as well as in the failure of governments to stick to commodity standards, which is classically the case, especially when war breaks out. Commodity standards are commonly paused and stepped away from because then the government can just print and print and print and spend money and fund war instead of sticking to the commodity and remaining on an honest metric of exchange of value. So in regards to Bitcoin, the price right now, it's speculative, it's manic, it's manipulative. If you haven't already heard of it, I'd go read about tulip ball mania. This is just one example of what's known as an asset bubble. It happened in the 1600s, and you heard me correctly, it had to deal with tulips, like the flowers. Yeah, people started trading their entire house or year's salary to get their hands on certain types of tulip bulbs. It was about a 2-year market, and guess what? It had an abrupt crash and burn. It was completely driven by speculation and subjective value over tulip bulbs. Many people went bankrupt, and also many people made money. So I'm not sitting here saying you can't make money off of Bitcoin, and nor will you not be able to in the immediate future necessarily. I'm sure a lot of people profited quite handily in tulip ball mania, but the point being is that there was a manic 2-year run on tulip bulbs, and then everything crashed and burned. Now, look at Bitcoin and cryptocurrencies. They promise a lot more than tulip bulbs, and they're quite more complex, so understanding the mania and how long it could last is hard to put a finger on. Not to mention that they are unregulated, they're outside of anyone's control, so the ability to bring order and regulation to it is also not possible. So it leaves a lot of issues in regards to the manipulation and speculative and manic effect on the price of Bitcoin. To comment again on the speculative nature of Bitcoin, I think it's important to understand where value comes from. I got some of this information from Jim Rickards in his book, A New Case for Gold. He lays out how there's really two different ideas on value systems. There's intrinsic value or there's subjective value. Intrinsic value is an idea that ultimately was adopted by Karl Marx in his Communist Manifesto and basically submits that the value or price of an object is directly related to the amount of human labor and capital and resources that went into it. Meaning, if I have to spend a bunch of money to dig gold out of the ground and use a bunch of human resources, that the gold that comes out of it is represented, or the price should represent, all the value that went into it. Now, we can do a couple thought experiments to see how this is complete crap right away. Ask any person who's ever created a product or a business that nobody wanted and couldn't sell, and ask them how much intrinsic value their product had. None. I think we've all done it. We've all spent time and days and a lot of effort on certain projects or endeavors in our life that largely went nowhere except for maybe some personal growth. Simply because we put a bunch of time, resources, and effort into something does not guarantee in any way that it's worth anything to anybody else. So intrinsic value belongs in the trash can, just like Karl Marx and just like the Communist Manifesto. On the other hand, we see what's known as subjective value. And this is the fact that we humans all have our own subjective value on things, and you versus I values things differently. A certain camera, a certain product like gold or anything, a certain piece of art, we will have our own assessment of its value. And that is where free markets and supply and demand economy come into play. So when we look at gold, simply because we can pull gold out of the ground and it takes a lot of effort to mine it and all sorts of stuff, does not necessarily give it any value. And that's why Bitcoin has a big question mark on it right now, because the value is really up to us. It's up to humans to decide how much value should Bitcoin be given, and we will have to see how that proves out. This is mainly why many of the prominent people and voices on Bitcoin, such as even Robert Kiyosaki, Simon Dixon, and Jimmy Song, all comment routinely on its speculative nature and just thinking that it's going to take time to prove out. I am a Christian by faith, and so I actually really like the subjective value argument because I believe in what's known as a property instinct. This is the fact that God created all things and said they are good. Because God created things and said they are good, there is an innate desire placed in us to want them and to acquire them. Now, that doesn't necessarily ascribe any certain amount of value to them, but the fact that God created gold, silver, and gems, and even in scripture talks about them being used as money and as wealth stores, teaches us that humans will always assign a value to them as a wealth store and that they will have usefulness for money. And because of that, again, commodity standard price equilibrium will be able to achieve between supply and demand markets for gold, silver, and related commodities between their use as money and the consumptive purposes for which we humans will always want to use them. Jim Rickards, in his book, A New Case for Gold, I think downplays this a little bit and claims that gold is only useful for money. But I would claim that the fact that gold is useful for money is exactly what creates the consumptive market. If we didn't recognize that gold was a wealth store and that it could be used for money, we would not have nearly the desire that we have for it. But because we do, there is a consumptive market created. Bitcoin will never have that. We can't wear Bitcoin. We can't use Bitcoin. Bitcoin can't be used for money because it can't be regulated. And there is no industry usage for Bitcoin outside of theoretically money, which again, it can't be. Robert Kiyosaki in his book Fake discusses some of his beliefs in regards to wearing gold and talking about, I think, how he learned it from a Hindu teacher about how wearing gold attracts wealth. And ultimately, when I first read the book, I didn't quite understand what he was trying to say. I do think there's a bit of a difference in faith and religion going on there, but now having understood the property instinct, I believe what he said makes sense because, like I said, we all have the innate desire in us to desire good things, desire the things of God, and understand that those things like gold were given to us to be money and a wealth store. We therefore are naturally attracted and drawn to them and create a consumptive market. And this is exactly what I would submit Kiyosaki has noticed in his belief in regards to wearing gold and how it will attract people and wealth, because people see you wearing it and they are naturally attracted to that metal because of their property instinct. So I would submit to you that our very nature and the things programmed into us are what make us see metals as a value store of wealth and recognize their usefulness for money and therefore continue our high subjective value placed on them. Bitcoin, though achieving many principles of gold, such as its limited use or scarcity, will never be able to satisfy that property instinct within us and create the consumptive market simply because there is no consumptive purpose for it. Therefore, there will be no stability, there will be no equilibrium price, and it will never function as money or gold 2.0. So, to quickly recap everything I've said, Bitcoin is never going to be able to disrupt the gold market or become gold 2.0 simply because it is not a sound commodity. There will never be a consumptive market. There is no usefulness for it outside of theoretically a currency, which it cannot be because it is unregulated and decentralized, and therefore no institution will be able to regulate the supply and demand of it in and out of a commodity based on the market needs. Therefore, because Bitcoin can never be real money, it will never leave the speculative valuation that it has now and become truly accepted by humans as having subjective value for the use of money. And again, because there's no consumptive market for it, it will also be recognized as not being able to satisfy those needs. Therefore, once the mania, speculation, and manipulation of it is done, it will crash. The price will go way down and will be worth nothing. This is exactly the same thing that Jacob Oracle, again on Twitter, says as well, although his view is that this is going to occur once some form of regulation and litigation occurs on these companies that are manipulating the market and operating in the wild, wild west of the crypto sphere. All in all, I hope you found this video educational and that it made sense to you. I apologize if not. I'd like to do better. It's a very deep, complex topic, which is why I think there's so much confusion and hype and mania around Bitcoin. Please like, comment, and share this video with others if you understand it or you think they will. I think it's important that we get this message out there and start calling attention on the crypto industry and the way in which it's causing a lot of issues and ultimately more wealth inequality in a system that already has a lot of it. Thank you and have a good one.